Nice.
All right, everyone. Appreciate you joining today. We are going to give this a couple minutes for everyone to filter in as we start getting all the participants in, which is great. I'm seeing 9 people so far. If you want to, hopefully this time I activated the chat. Last time I thought I did. I went through and made sure I did it this time. If you want to just pop in your name, where you're calling in from, your LinkedIn, we could all connect. We included Peter's, myself, and Carta's data minutes, which is an incredible source of information they compile that everyone should subscribe to post this meeting. And we'll do some intros in a couple minutes, but we'll let the rest of the group kind of filter in here. Hey, Frida. Excited to come down to Miami and see you all in 2 weeks. And if you're either actively fundraising or looking to get onto the fundraising trail here soon, maybe add a reaction, a celebration, or something of that nature. Peter's going to be the man to walk you through that whole process.
Yes, no funds promised, though, I must say.
Ooh, Peter, you have Luke has been a long time lurker. It's like on the cusp of scary, but it's great to see you, Luke. happy to have you here.
No, long time, first time. I love it.
All right, I'll get it going. We got a good group here. We'll let people filter in. Everyone's got a busy day, so I appreciate everyone joining us. This is the second installment of the Bionic Colabs community chats. We really appreciate everyone that signed up and supported us so far as we're building our collaborative. As we know, as we talked about last time, the current economic condition is really complicated for founders. There's a lot to navigate when it comes down to fundraising, to building your business, to extending the runway, to allowing yourself to continue to scale efficiently and effectively. And so it's really important for us to bring together these community chats of experts to share their wisdom, share their insights, help, iron sharpens iron, in our opinion. And we want to make this in a real way for us to share insights ongoing. We'd love to have Peter here. We're excited that he's able to join us. Hopefully we'll be able to do this every so often to give us updates on what's happening in the fundraising landscape and the overall environment. As a quick background, as I mentioned, Bionic is a collaborative that brings together early stage startup community for founders and operators and partners, which we call our orbit, which Peter and Carta and others are a part of. We're collective and focused on building more durable companies with sustainable and scalable growth to reach market fit faster. Startups are hard, and we're here to help break down the walls to go further together. About me, my name is Justin Cohen. If we haven't met, love to connect on LinkedIn. But I've been in the startup ecosystem for 20 years, building marketing and product functions at the early stage, employee 1 to employee 10 at fast growth early stage companies throughout Chicago. Been a part of a couple exits, been a founder as well. So I know the struggles and challenges, active investor with over 15 companies in the angel portfolio, and mentoring at Techstars and others, and now building Bionic Colabs with the team. So excited to have everyone here. We're going to be recording this session, so we'll be able to send it out to everyone post. And if you have any questions, there's the Q&A button at the bottom. Please drop your questions in, upvote them. I also remember to enable that this time. And I'll call the questions to Peter, and we'll do some follow-up during the session and also after. And we'll announce our next community session at the end of the chat. So without further ado, I want to do a quick intro about Peter, and then I'll let you do your intro and take it from there, Peter. So Peter Walker runs the insights team at Carta, focused on discovering key narratives across the private market ecosystem. Prior to Carta, he was the head of marketing for the media analytics company Public Relay. He also led the data visualization team at the COVID tracking project at The Atlantic during the peak of the pandemic. He and his wife recently welcomed their corgi puppy Penny into the family and introducing her to everyone of San Francisco's many parks. That's great. So I'll let you take it from here, give a little background on if you want to give anything else and about Carta, and let you present, and I'll sit in the background and be wowed by all the great insights you have.
Well, appreciate it, Justin. Thanks for the intro. Yeah, we can talk about corgi puppies instead of fundraising if everyone's excited about that. Just let me know. So, yes, appreciate you all letting me come and chat today. Hopefully you're familiar with Carta, but if you're not, Carta is a cap table management platform. We have about 40,000 companies across the US and indeed the world that use us to help grant equity to employees, advisors, investors, and keep their cap table succinct and clean so that they can focus on building instead of focusing on equity. The other side of our business is we have about 2,500 or so venture funds for whom we manage their back office, meaning tax, audit, valuations, everything that you could entail about being a venture investor. We help those funds manage themselves a little bit more cleanly with a lot of technology. So those are the two sides of Carta's business. As you can imagine, being a player on both the fund and the cap table side gives us really fantastic data on what's going on in the venture market overall. So that's the kind of stuff that we're going to be touching on today. I'm going to go ahead and share my screen. As Justin mentioned, throw questions in the chat. Interrupt me if you want to. Totally fine for this to be, less lecture and more conversation. But if you just want to sit back and relax as we run through all this early stage startup fundraising data, that's cool too. All right, so why should you trust this data? At the top, again, 40,000 companies who have collectively raised $320 billion. So we think it's the biggest private data set in the world, if you don't count, if it's a first-party data set and ignoring PitchBook and others that source from a lot of different places. If you're a founder today, the only pitch I'll give you here is that we do have a free program called Carta Launch. It is every single one of our cap table features entirely free until you raise $1 million. So you can issue equity to your team. You can raise on safes with 6 clicks or less. You can have a private data room to give access to your investors. Anything and everything you want in order to build a proficient cap table is available to you for free until you raise your first $1 million. That's cartalaunch.com, or carta.com/launch, I should say. All right, let's get into the fun stuff. Fundraising for startups. So to take a step back, most of the early stage fundraising that we see is happening now through 2 types of instruments. One is a SAFE, and the other is a convertible note. The SAFE is the simple agreement for future equity, popularized by YC and the law firm Wilson Sonsini. And it's essentially the contract is a promise. Upfront, the founder receives capital, and then when they end up raising a price round, if that should happen down the road, the investor in that SAFE will convert that capital into equity at the moment of the price round. So why are SAFEs important? SAFEs are important for a couple of reasons. So first, they came about because it's very difficult to actually value an early stage company. It's almost impossible, really. And so a lot of investors are saying, look, we want to bet on this founding team with capital, but we're okay leaving the valuation discussion to a later set of investors when the business is a little bit more mature. And the SAFE kind of solves for both the upfront capital needs and the equity participation down the road. So the data that you're looking at right here, this is the amount of capital that is raised by pre-seed startups on Carta every quarter. You can see it peaked at about $1.5 billion in early 2022, and it's running at about, call it $1 billion or so in 2023. That's down, certainly from the peak, but it's actually doing pretty well. This part of the market has been the most robust when you're talking about the venture market as a whole. If you have founder friends who are Series B, Series C, et cetera, they're facing a lot more pain than some of the pre-seed founders at the moment. As I mentioned, the reason I did that upfront about SAFEs is because they have come to basically dominate. They are the default instrument on which pre-seed founders are raising capital. It used to be that convertible notes, that's the blue line, SAFEs is the black line in this chart. It used to be that convertible notes were kind of equal to them, but more and more people, founders and investors alike, are choosing safes. The only real difference between these two instruments is that a convertible note is actually debt. It comes with an interest rate, it has a maturity date, et cetera, whereas a safe is a promise for equity in the future. So more and more people turning to safes rather than convertible notes. However, if you're in specific industries, you may find that your investors are more likely to insist on a convertible note. Those are industries that typically deal in the real world. Things like medical devices, hardware, energy startups. A high percentage of the capital into those startups at the very earliest stages is still running through convertible notes. But if you're raising for a SaaS company, a fintech company, an ed tech company, the vast majority of what you're going to raise on is a safe. And again, you can run safes through Carta. There's a lot of great data there, as well as some explainers about how to use them and things to watch out for. Okay, so when you're talking about fundraising, yeah, go ahead.
Yeah, if you were a founder, kind of seeing the stratification that's occurring between convertible notes and safes, what do you think is the biggest driver of that? And do you think there are any benefits for founders outside of the physical space to look to use convertible notes in their first round?
It's a great question. So the reason why I think things are happening through the safe is essentially it's gravity. Like fundraising flows through the path of least resistance. And once safes have become sort of default, most people will just choose the default point, heavily popularized by YC and their post-money safe. However, there are drawbacks to safes. One is that depending on the type of safe you're using, you may not exactly know how much of your company you're giving up in any given fundraise. So that's an issue if you're a founder. Two is that on the investor side, some investors really don't like safes. And the reason they don't like it is because you can imagine a case where a startup fundraises on safes and then never ends up raising a price round at all. And so when does that initial investor actually convert their capital into equity? Well, it's really messy. It might never happen. Now, it might never happen because the company goes out of business and then, you really didn't lose that much. But it might never happen because the company just says, actually, we're going to pivot and be a bootstrapped company now instead of a venture-backed one. And that can get really tricky. So some investors do prefer convertible notes. Is there a reason why a founder should prefer one or the other? Most of the time, if I'm being completely candid, the founder, especially these days, is not going to have a ton of leverage as to which instrument they get invested into. It's going to be a decision between you and the investor. And the investor, if they hold the capital, typically holds a little bit more leverage. The advantage of a convertible note is that because it comes with an interest rate, and that interest rate has a maturity date, it effectively forces the founder and the investor to have a conversation about where the business is on a fundraising terms at that maturity date. Most of the time, an investor that invests on a convertible note is not actually expecting to get 8% interest out of this tiny angel investment. Like, it doesn't make that much sense. It's more of a forcing function for a conversation. So both are good. You're going to find more convertible notes in certain industries, and you're also going to find more convertible notes outside of Silicon Valley. So if you're raising in Dallas or Charlotte, it's more likely that your investors are going to be comfortable with a note than a safe, although that's changing across the country as well.
Awesome. Thank you.
Yeah, great question. So here's the split. Digging a little bit more into safes, there are two main kinds of safes, a post-money safe and a pre-money safe. As you can see from this chart, the post-money in blue, the pre-money in green. You tell me when Y Combinator switched their default template from post or pre-money to post. That has a big, big impact on what is the default around, especially Silicon Valley, then, of course, the rest of startups. Most of the money goes through post-money safes. To be clear, post-money safes are more favorable to the investor than they are to the founder. And the reason that is because by using a post-money safe, you are effectively locking in a percentage of your company. So taking that as an example, if I raise $100,000 in safe, a post-money safe, and my valuation cap for that safe is $1 million, I have given away 10% of my company. I have sold, 10% of my company. If instead I did that exact same math, but on a pre-money basis, then the actual percentage that I've sold is variable depending on the next round that I raise. So post-money gives investors more certainty, but it does mean more dilution for the founder. Most of the time, again, you're probably going to raise on a post-money safe. It's the standard YC document that you're going to find all across the web. So I just spoke about valuation caps. There are two main criteria for a safe that you should be familiar with. The first is valuation cap, and the second is discount. So a valuation cap is the maximum level at which this safe will convert into equity, no matter what you do in your price round. So again, if we take that example, you raised $100K on $1 million cap safe. If 2 years from now, you end up raising a seed round for $5 million, well, that initial investor that gave you that safe, they're going to convert their equity as though you raised at $1 million valuation instead of a $5 million one. They're going to convert 5 to 1. It's a way for early investors to get more equity down the road for taking a chance on you earlier on. Discounts function in a very similar fashion, or a little bit distinct, in that they simply say, look, whatever you end up raising that price round for, we're going to take 20, 30% off of that, and we're going to give your earliest investors a discount to that preferred round. So as you can see, valuation caps are very, very common. About 90% of safes have valuation caps. Probably about 30 to 40%, depending on the kind of safe, have a discount. So 2 terms to be super familiar with, val cap and discount. If you find an investor that gives you some of those purple bars, which is no discount, no val cap, just cash, that's like friends and family stuff. That's very kind of that investor, but you shouldn't expect it. All right. So the number one question that I'm asked when I give this talk about safes and fundraising for early stage is they say, all right, Peter, I understand that I should probably raise on a safe. How do I decide on my valuation cap? And I'm here to tell you that while some people might say it's really dependent on the kind of company or like the intrinsic value of your business, I'm here to tell you that the vast majority of how to decide your valuation cap comes from how much money you want to raise. So if you work backwards, you come from the first question, which is how much money do I need? And then you work backwards to what should the valuation cap on my safe be? And the reason that you do it that way is because that dictates how much of your company you're giving away. So if you look across these lines, if you are raising less than $250,000 on a safe, your valuation cap median is about $5 million. That's that left-hand column. If you go to the middle column, 500K to 999K. So if you're raising between $500,000 and $1 million, your safe valuation cap is between 8 and 10 million. So you can see that that dictates about 8 to 10% of your company. Again, if you raised $1 million on a $2 million valuation cap, you have just given away, or you have just sold 50% of your company. And that's going to be really difficult for you to overcome down the line, because your Series A, your Series B, your Series C, those investors are going to want healthy portions of your company too. And now you only have 50% of it left to sell. So be careful about how much you're diluting yourselves when you're raising on a safe. I'll pause here because that sometimes is a little tricky. Any general questions on that before we move on? Okay, cool. Now, there are distinctions between industries when it comes to fundraising on safes. As you can imagine, if you're building a pharmaceutical company, your capital needs are going to be different than if you're building an education tech company or a DTC retail company. So these can be all over the place. Yeah, Q&A on expected dilution between rounds. I can definitely touch on that in a little later on, but I'll come to that for sure. This chart shows you each bubble is an industry. The higher the bubble, the more median cash. The further to the right, the higher the valuation cap. In general, I think the biggest takeaway from this chart is that you can see there are a ton of industry bubbles that sort of default to 10 million or 8 million, which just goes to show you when you're working with a safe, people treat the valuation cap as an effective valuation, but it isn't discussed or debated nearly as much as an actual valuation is. It's very rare to have a valuation of 10 million on the dot when you're doing a price round. It would be 10.5, 11.5, 11.2, a little bit more specific to the business. So this shows that people just kind of defaulting to round numbers, and that's due to the dilution effects of safes. And yes, there are still Web3 companies raising on the upper right there. So Web3 isn't dead completely. So you can check all your safes at carta.com. And I think one of the key points here is that you are probably going to run into safes, not just for your earliest financing, but sometimes for your seed round as well. So I took a look at every single round on Carta where at least $1 million was raised, if it was the first price round or on safes. And it used to be that most of those $1 million rounds were happening through priced equity, but now it's 50% of them are happening through safes and some through convertible notes as well. So if there's one takeaway from this talk, it's get very familiar with the safe, how it dilutes, how it converts, maybe talk to a good lawyer friend about it. And it's a really great way to up-level your knowledge about the way fundraising works in venture today. All right, that's pre-seed stuff. I've got a bunch of other data on seed rounds and all that kind of thing, but maybe I'll take one of these Q&A questions right now. Otto's question in the chat was, should we expect different safe terms by investor type? Fantastic question. Yes, you should. The terms of a safe are pretty standard. You basically have pre or post money and valuation cap and discount. So effectively 3 different terms that you need to be track of. What's happening more and more frequently, though, is that sophisticated investors, so these are VC funds that are giving out pre-seed checks, they are demanding what's known as a side letter alongside the safe. And the side letter has a lot of different terms in it, depending on the VC. So they may ask for MFN, most favored nation. They may ask for pro rata in the next round. They may ask for information rights to your cap table. All of these are non-standard terms for a safe, but they're pretty standard terms for a priced round. So you can see the priced world and the safe world, they're sort of like merging and melding and getting kind of weird over the last couple of years. So yes, you should expect that the more sophisticated the investor, they may ask for more sophisticated terms, even on a document like a safe. And I maybe should have explained this at the top, but why are safes popular? Because they're fast. They cost less in legal terms. You can have a rolling safe, so you can get a $10,000 check today and a $50,000 check tomorrow, and you don't have to wait for the whole round to be done. It's just a faster, more efficient way to fundraise, but it definitely leaves you open to some dilution questions down the road. So safes are great, but they have some drawbacks. So hopefully that was an answer to your question, Otto. Can you share this deck with us afterwards? Absolutely. Definitely, we will share this deck. And I guess I'll touch on this last question now, and then we can go over to the seed rounds. Or maybe we can jump into it. So I'll save that dilution question for a bit. Okay, so you've raised your pre-seed. Congratulations. You're on your way to hopefully having customers, maybe some revenue in the door. You're thinking about your first venture round, your first priced equity round. So why is it called a price round? It's because you are actively putting a price per share on your company. And the reason you do that is you know how many shares you have outstanding, and then your investor comes in and together you value the company, you give the company a valuation, which naturally means that if you divide that valuation by the total number of shares, you have a price per share. So that's what a price round does. It also comes with more lawyers, comes with more time, more terms, et cetera. But effectively, that's the difference between a price round and a safe round. You can see from this chart, seed rounds, priced seeds, the volume there in the top bars has fallen off. We saw 900 price seed rounds in a single quarter on Carta in late 21. And in the most recent quarter, it was 462. So quite, about half. So still a decent amount of investment into seed rounds, but it definitely has gotten harder than it used to be to raise a seed round. And that's even probably more true for Series A and beyond. So this has gotten more difficult to fundraise from VCs. And interestingly, you would expect sort of, just looking at this from a broad level, that, okay, if there's less fundraising, it means that, VCs are a little bit down on the market. So probably valuations for those companies have dropped as well. And you can see that in the earliest part of the market, that's just not true. The white line in this chart is the pre-money valuations, and the dotted orange line is total rounds completed. So in the late stage, volume and valuation, they fell together. In the early stage, valuation stayed pretty high while volume fell pretty drastically. What's happening there is that a lot of VCs are now interested in seed rounds who weren't before. So there's some competition for the highest rounds there. And also, to be honest, if you see like headlines in TechCrunch about these VCs raising, $200, $300 million funds to invest into seed companies, it's very difficult to invest $200 million into seed companies if you're investing $3 million per round. So those valuations can't really go that low. It's not possible for a fund of that size to invest in $50,000 checks. It just doesn't make sense for their economics. So a lot of what's happening in seed is actually dictated more by investors than by founders. You're going to hear a lot of different terms when you're fundraising about bridge rounds, extensions, seed plus is a new term that people are throwing out. All of this means that you raise a seed round, and then your next round, the standard terminology is your Series A. But maybe you talk to Series A investors and they say, hey, you're not really ready for a Series A. We need to see more revenue. We need to see better capital efficiency, whatever it is. So you go back to your current investors and you say, hey, y'all, I think I can get to a Series A, but I'm going to need some more cash up front so that I have some time to do it. And that's where the bridge round comes in. A ton of time and attention is being spent on bridge rounds right now, as opposed to new primary rounds, which is kind of a negative sign, to be honest. Most of the time, VCs would rather be investing into new companies than following on to bridges with their current portfolios. So it's a difficult time here for VCs to choose among the people that they're working with, excuse me. Important to note, you should expect that it's going to take longer than you think to raise your next round. The days between a Series A and a Series B, or a seed round and a Series A, they keep going up. It used to be common to say you need 18 to 24 months between rounds. Well, now the average for Series A to Series B is 2.5 years, not 24 months. So it's 30 months. So expect that you're going to need to make any fundraising you raise last longer than you think. It always needs to last longer than you think. It's a good rule of thumb for all the entrepreneurs listening in. Right now in the US, seed round valuations are about 13.3 million. That's pre-money. If you add in the cash in that round, which is about 3 million, you get to about 16 million or so in post-money valuation. That's pretty healthy. That's pretty close to where it was in the peak in 2021, not inflation adjusted. So seed rounds, again, valuations are pretty healthy there. How much of your company will you sell in one of these seed rounds? About 20%. This is one of the rules of thumb in venture that is actually very true, is that you sell about 20% of your company in your seed and your Series A. So you add that up, you say, okay, that's 40% for seed and Series A. I got to set some equity aside for my employees. I also maybe raised on a safe, so that's maybe called another 5 or 6%. And you're getting pretty close to saying, hey, I own 50% as a founding team or less of my company by the time I different depending on the specifics of your business, but it is a good rule of thumb to keep in mind. You want to try to own 51% or so of your company if you can after your Series A. Just puts you in pretty good stead for the later dilution that you might take on from investors. It's not true in all cases. It's not like a hard and fast rule, but it is a good way to kind of give yourself a rubric where you slot into the rest of the venture ecosystem. All right. I know we just ripped through all of that, but I wanted to save time. Go ahead, Justin.
When you're looking, a couple questions, and then we have some in the Q&A, but based on when you're looking at this bridge round scenario, which I see increasing as well as resilience has to be there, get back to fundamentals and kind of retrench themselves. And
Yep.
are you kind of expecting or hearing from venture funds that because of the retrenchment will occur, there's potentially more creative or better rounds for founders if they have, you know, better metrics that come out of that? Or is this just a pure survival play? Like where do you see, you know, you mentioned as potentially negative, but where do you see this as industry wise, and how does it impact us, crystal ball, you know, 1, 2, 3 years out?
It's a good question. Sorry, I keep putting back and forth. It's a bit tough to answer on a blanket basis. I will say that unfortunately, I take most of these extensions and bridges as a negative sign. It means that founders had unrealistic and or the sort of rug was pulled out from them expectations about what it was going to take to raise the next round. So something you're hearing across venture all the time is, hey, in 2021, I could have raised the Series A with 2 million in ARR, and now I need 5. That kind of stuff is happening more and more frequently. And the data that I'm not showing in this deck, but is the other side of the bridge rounds, is 1, down rounds. Down rounds are up a lot. And then 2, startups closing up, shutdowns. And shutdowns were up about 250% from 2022 to 2023. So a lot of founders, especially founders who started their companies in 2019, 2020, who grew up in the zero interest rates era, are having real challenges pivoting to this new high interest rate growth is more difficult kind of framework. You know, if you're running a business for 4 years under one economic profile and then you have to jump to another one, it's really challenging. So it's not easy at all. I actually find probably that founders that are beginning today, it's difficult, sure, but at least they're growing up in the difficult thing from the beginning. They're not like kind of getting on that softer growth train and then having to really change tracks. So in some ways, maybe that's a silver lining for people who are starting companies today.
Yeah, I agree. I have more questions, but there's a bunch of questions in the chat, so I think we should jump in there. So we want to jump back up to the first question, which is, can you talk about expected dilution between rounds at some point?
Yeah, definitely. And yeah, appreciate all the questions, y'all. Expected dilution between rounds. So we talked about this a little bit. I actually have, I think I have a graphic out today on LinkedIn about this. Typically, it's a good rule of thumb to say 20% your seed, 20% your A. Now, that is not taking into account 2 main things. One, how much you're converting from your safes. And we are seeing, in a bit of a weird trend in my mind, people using safes and convertible notes in between priced rounds. So like you raised a seed round, you've done priced equity, but then you raise a safe again. That's okay if that's your only capital efficiency, but it does get really tricky. It like sets you, I find that to be tough sometimes for founders. So how much should you own? You know, this is a wonderful question from founders all the time. It's like, how much of my company should I own at various stages? Some of it comes down to negotiating leverage, y'all. Like it's not a one size fits all kind of thing. I think that 51% exiting an A is a good rule of thumb. But if the only capital you need or can get makes it so you own 45% after your A, and you really believe in these investors and you think it's a values aligned transaction, then do it. Like, you know, it's your business. You should fundraise how you can and how you think you can deal with the dilution and how much capital or how much investment, or excuse me, equity you need to feel incentivized for the future. We also have great data on like how you split things among co-founders. We can get into that in a different time, but
Yeah. One thing I've noticed, and I wonder your thoughts on this too. It's like when I talk to a lot of founders, sometimes we shoot a little too low with how much we want to raise in that initial round just to get the business off the ground. Maybe that
Yep.
pre-seed or seed, we expected 18, 24 months runway, but obviously we want to make investments and grow. And instead of maybe going from $2 million round, we're going at 500 because we think that's enough for us at this point. But then you get in that situation where you need more sooner and you have to raise, and then terms become harder. So have you seen, a trend to like try to raise as much kind of initially as possible to sustain, and then hopefully you get into a better position, we have better unit economics and better growth, versus, always giving up that 20%, and raise.
It
Almost
definitely
skipping around.
No, definitely have seen founders who make the conscious choice to say, I'm going to try to raise more than I expected because I bet it's going to be difficult down the road. That's a totally reasonable thing to do. The one caveat I have on that is if you're doing it on a safe, because the safe is rolling, it can kind of feel like you're just always talking to the next angel who's going to do a 10K check and that kind of stuff. And if that's taking too much time away from you building, that can be a difficult thing to kind of suss out. Where should you be spending your precious time? So that's one thing. What we've found is that some of the dynamics that used to exist in priced equity are now filtering down into safes. The primary one that I'm thinking about here is like lead investor. So if you can get a safe, if you're trying to raise, call it 500K on a safe round, but you can get a lead that comes in gives you 200 of that 500 up front. If you can close that lead, it actually makes the conversations with the other investors easier because you don't have to argue terms or anything. You're like, look, you're giving me 25K. I have an investor who gave me 200. Like, I'm assuming it's okay if I give you the same terms as that other investor. And that's a maybe an easier way to streamline some of those conversations. Again, not possible for everyone though.
Yeah. No, the reason I bring it up is because when you showed the extension between rounds up to 30 months, to raise the cycles, the timing, it's kind of strike while the iron's hot. And you may take a little more dilution up front on your business than maybe what you expected. That additional capital is lifeline to your business. Capital gives you the ability to extend and ability to experiment and ultimately find product market fit, which then once you do that, you ultimately will have, I think, better rounds and an easier chance to raise that seed plus, or even a round if you're going forward. So just things to consider.
Totally.
And then I think the next question we had was, if you're raising on a convertible note and ask for your valuation, should we still use the safe valuation cap metrics? That is 1 million raise is between 11 to 12 million valuation for the convertible note.
Yeah, I think it's still a good yardstick for what you're going to convert that convertible note or what valuation you're going to convert that at. Convertible notes are slightly different. Obviously, the big difference again is that they come with the interest rate, but they're also very typically, there's more cap and discount in convertible notes than there are in standard safes. And they're just, you're not going to, the valuation is effectively decided the exact same way. But again, my number one advice is work backwards from the amount that you actually need. So, and then what your dilution looks like. If you are a co-founding team of two, like have the conversation about, how much of this company do we need to own in order to feel properly incentivized by X, maturity date or venture stage, and you can work backwards with how much you can give away up front. To the other point on round sizing and like, should you try to raise more or less at the earliest stages? There's a like a meme, not a meme, but like an idea going around now across a lot of venture, which is, maybe we raise a seed, maybe we raise a pre-seed and a seed, and that's it. We get off the hamster wheel. And like from then on, we are just customer revenues, and we're profitable, and we don't need to raise any more funding. I think a lot of companies are going to try this. And I don't know how many are going to be able to do it. There's a big difference between being a customer funded business that grows at slightly lower rates amazing outcomes for the founders and everyone involved. No shade at that business at all. That's a fantastic way to build. But the difference between that and being a venture scale business is rather large. So there are not a lot of venture scale businesses that have gotten there without venture money in recent years. MailChimp is one. There's a couple other ones, but that, most of the time you're going to be fundraising in order to supercharge growth. So if I'm wrong about this, I'd love it. Like maybe the introduction of AI and other things really do make it possible. Sam Altman's talking about how there's going to be $1 billion company soon that's has one employee. Maybe I think it seems a little far-fetched to me right now, but maybe I'm a Luddite on that one.
Interesting. Next question is from Christine. Is the dilution trending slightly down? Is it good news for founders?
I think it is good news. I would say qualified good news, Christine. So yes, in primary rounds, dilution has trended downward. And most of that is people outside of Silicon Valley sort of coming to Silicon Valley terms. So maybe 5 years ago, you would say the same company that's fundraising in Dallas versus San Jose. In San Jose, they would give up 20% in a seed, and in Dallas, they'd give up 25. Now those two worlds are merging a little bit, which is great to see. Less dilution for founders. However, the top line dilution doesn't take into account some of the underlying dynamics within the deals. I'm thinking specifically of deal terms like high liquidation preferences, participating preferred stock, these things that can make it seem like it's a good deal on the surface, but then you actually read through the contract and you're like, wow, this investor is going to get paid out way more than I am, even though that the valuation deal was good. So just a heads up, those terms are on the rise a little bit.
Awesome.
Which means, honestly, just like get a good lawyer when you're raising a price round, for sure.
Awesome. Next up, outside of raising, the other end of it is closing companies. How do you see people closing shop or returning money with safes and different fundraisers evolving?
Yeah.
Is there like an industry standard practice?
There's not an industry standard practice. We're actually really thinking deeply about this space right now. We actually have a product that's more of a service called Carta Conclusions, where founders on Carta who are thinking of shutting down their companies can come to us and we can help them with the tax implications and how the payout goes to your cap table and all that stuff. Are most founders returning money? No, most founders are not returning money. There are some companies for whom the founder looks at it and says, look, I don't think that this is a business, and returns what capital they have. Most of the time in a shutdown, the investors are coming away with very little, if anything at all. That's true for the founders and employees as well, obviously, but yeah, it's not a lot of people who are just giving money back.
Next up, we got from Otto, how common are roll-up SPVs or crowdfunding for pressed friends and family investments?
So yeah, roll-up SPVs, AngelList calls them RUVs. We call them cap table vehicles. Pretty common. Not everybody. And for the other people on the call who may not know what those are, the purpose of a roll-up vehicle or an SPV in that way is to say, instead of having 50 different individuals listed on my cap table with small checks, I aggregate them into one line on the cap table with a big amount of money. And then the sort of information is handled differently. The approvals for board is handled differently. It just kind of helps you manage those investors a little bit more easily. They're definitely present on cap tables. They've actually become a little less present than they were in 2021. Everybody was doing party rounds and stuff in 2021. Now that's receded a little bit. But definitely an interesting and cool way to do it if you're worried about the time it's going to take you to manage a bunch of small checks.
Yeah, I do know Carta recently acquired an SPV provider, right? A couple years ago.
Yeah, from Europe, called Valbon.
From
yeah.
Europe.
So
yeah. So an interesting opportunity, like if you're using the Carta platform to kind of allow for SPVs. Have you, I've always seen different viewpoints from other venture individuals when you get to, actual VCs about SPVs, about, AngelList, or about crowdfunding that may not have great connotations for the ability to raise, from true angels or from true VCs. Do you see that is that still looked at as kind of a black eye, or is it becoming more normal? What's the approach there?
I wouldn't say SPVs are looked at poorly. I will say crowdfunding is a different thing. If the majority of your funding comes from something like a Kickstarter or even a Republic, that there may be VCs who view that negatively. If you have just, 10 to 20 strategic angels who you rolled up into a cap table vehicle, like I think people are pretty cool with that. Now, what you should want though is if you have angels that are well known in your industry, you should have them have their own individual line on your cap. So you can point to them and say, hey, look, I am an e-commerce platform and this, Toby from Shopify is invested in my company. You want that front and center so that you can prove to other future investors, hey, there's credible people that are kind of excited about what I'm building.
I have two other questions. One in the chat I'll read from Luke. He says, anecdotally, I'm seeing businesses who are really tech companies, but more CPG or tech-enabled services companies, like a tech-enabled chiropractor businesses, wellness clubs, etc., raising on safes.
Yeah,
I'm assuming this is a pretty new thing, or what have the trends been like that with that?
it is a pretty new thing, and I'm a little worried about it. Like it comes back to the eventual conversion of these safes. Like, if you're a dentist's office who's using some dentist tech, will you end up raising a price round later on, and then will those safes ever convert? There are other ways to fundraise for non-venture businesses that are not safes. So I think it is A, new, and B, sort of an outgrowth of everyone getting really excited about angel investing in 2020 and 2021. We were all at home, and we turned to Robinhood or other different ways to spend time and invest money. Like there is some truth to that just becoming more of a well-known thing in the culture. I don't think some of those businesses, it will turn totally fine. And of course, you can add different clauses to safe so that they convert at different points or for different reasons. It's just not usually in the standard safe document. It's called what's known as a qualified financing. So you can define what qualified means there, but usually that means a venture round.
Awesome. We got one more here in the Q&A. We received a lot of interest from VCs for our seed, but currently our pre-product, pre-revenue. All we hear is we love it. Let us know when it's working and we'll come back to the table. Any tips on how to address this?
Oh man, well, I'm not an investor, so maybe I'm the wrong person to ask on this one. I feel as though a lot of founders hear that. Hey, we love it. Come back later. Effectively, what you should do is take that as a no, but you should add those people to your investor updates. And you probably at some point need to have an investor update for people on the cap, and then a second investor update that's maybe a little bit less specific for investors that are interested or interesting to you. Great way to keep them involved in the growth and progress of your business. And it's not to say, unfortunately, in this environment, there have been many, many cases where you're in a discussion with a VC and they say, hey, we love it, but we want you to hit X, Y, and Z, and then we can have a discussion. And you go out and hit X, Y, and Z, and they still don't want to talk. Like that happens all the time. So don't take it as gospel that if they give you a benchmark to hit, it means definitely they're going to invest. But do keep those as sort of lukewarm investors that you're thinking about touching. The other thing that we've seen really great founders do is they say, all right, we're raising a seed round right now. And in that process, we're going to meet with a few Series A investors who we know we're not ready for, just to get their sense of our business and include them in those investor updates. So you're working one round ahead. So you have a little bit of visibility into, okay, these are the financiers that I'm going to need to talk with 2 years down the line. I don't want to get to 2 years down the line and have to introduce myself. I want them to have been receiving our updates for a while and be interested in the business.
Yeah, I would opine on that. I think that's a great answer. I would say I agree with you wholeheartedly that it's a soft no. They're just extending it. VCs never want to like truly say no because they always want to be in the fold if anything becomes cool or interesting for them over time. I think it's good to get a no though early because you don't have to waste your time. I do think that if there's a VC that's early, that's chatting with you, and I think usually if you get yes and questions, like thinking about what you'll be like in the future, that's someone who's probably pretty interested, or they're sharing you feedback, they're giving you insights, they're making introductions. I would put those as more of a, these people are interested. We just do need to kind of push our product along any further. If they're just listen to your pitch and say, great, come back to us when you hit X, Y, and Z. Don't worry about that. That's not really going to go very far. Keep them in the loop on how things are progressing. Do not take metric advice from VCs who don't know your business, that just talk to you for 15 minutes. Like I said, like Peter said, they're going to just extend the goalpost. Again, it's just a soft, easy way to let you down, versus being upfront and saying, this just doesn't work for us at this time. Keep us in the loop on how you're progressing. So there's a lot of information you're going to get back and forth. Maybe it makes sense for you to reevaluate what VCs you're reaching out to. Do they actually do pre-product, pre-revenue checks? Some say they do. Usually how funds work is that 80% are all structured to whatever round they typically invest in. They go down 10, 20% or up 10, 20%. So if I'm a primary seed investor, I'll do 10% in pre-seed and 10% in A. So just because they do a little bit in that pre-seed or pre-product doesn't mean it's something that they do very frequently. So just looking at Crunchbase or looking at other tools to show you who they've actually invested in what rounds will give you a very clear idea if they're actually someone who would come in pre-product, pre-revenue. But as Peter said, like these are all relationships and conversations. When you're this early, it's all about trust. Do they like the team? Do they think that you could deliver on your promises and what you're going to be working on? Are you fiduciary responsible with the capital they're going to provide to you? So ultimately, you have to build that relationship with them over the 1-2 years that you're building. So just keep updating. Don't fall off with your quarterly or monthly updates, because that people do it, and it starts really great for the first month, 2 months, quarter, and then it just dies. And then then you lose touch, and then it's like, are there bad things happening, and what's going on with this business? So if you do it, stay consistent with it.
There's literally, it sounds so prosaic, but there is literally nothing better that you can do than just being consistent and reliable when it comes to like your interactions with investors. So if you're writing a quarterly update, write it every quarter. And if it can come out the day after the quarter ends, even better. Like that sort of alacrity just allows investors, whether or not they end up investing in your business, to trust in your consistency. And that consistency, it's shocking how much of a standout that can make you, even just doing that basic stuff.
Absolutely. Any other questions? We have a couple minutes left. We'll give it a second. If not, I had one last question for you, Peter. You guys have thousands of venture funds, in the portfolio on Carta, talking to them. Any crystal ball, anything they're telling you, now that interest rates are starting to come down a little bit, banks are starting to do a little more lending. Do we see the thawing happening? What are things that these founders should be thinking about for 2024 and 5 and beyond?
Yeah, I think so. Two things. One, I do expect fundraising in 2024 to be better than it was in 2023. I would be shocked if 2024 was worse. So there is that. It'll be bifurcated, right? There'll be people shutting down and also people getting big rounds. It'll kind of feel odd, but that's sort of just the nature of venture capital. The other thing, and this is maybe reading between the lines a little bit with these VCs, so if I'm wrong about this, please let me know, but I don't think I'm wrong. The message to many founders over the last 18 to 24 months has been, get to capital efficiency, get to profitability if at all possible, like manage your burn, show us your margins, etc. Fundamentally, that's not what VC is about. VC is about growth, especially at the earliest stages. So what has happened to multiple founders that I'm aware of is they've gotten their metrics and margins to a place that they heard from their investors, and then the investor says, you're not growing fast enough. So like venture at the end of the day is about growth. Growth is always the number one metric that goes into investment decisions. Now, is it tempered now by capital efficiency and margin profile and all that? Absolutely. But fundamentally, like early stage businesses, if you're on the true venture track, you probably shouldn't be profitable at seed stage. Like that probably means you're not spending enough on growth. So that may be a little bit of a contrarian take from a non-investor here. So feel free to disregard it. But the more that I talk to founders, the more that I get the sense that, you know what these investors really want at the end of the day, after they have the conversations about profitability and whatnot, they want a really fast growing business.
Yep. Yep, it's that double-edged sword you got to balance.
For sure.
But build the metrics, build the funnel, build the efficiency, and scale. But do it
And if you don't want to be
in
in
an effective way.
that's
Yeah.
like a great thing. I love the idea that more companies are just saying, look, venture capital is not for us. That's great. Like, awesome. You get to grow on your own timeline. You don't have to answer to investors who have different sort of assumptions about your business. That's awesome. Just like have that in-depth conversation with yourselves or your co-founders and others and be like, what kind of business do we want to be?
Awesome. Well, this was an amazing chat. I appreciate everyone being here. As we mentioned, we'll send out this recording. Peter will flip the deck over to me, and we'll share it with everybody as well. Put it in the calendar, and I'll send it out on April 21st at 12 p.m. Central Time. We're going to be chatting with Malcolm Lewis, who helps build startup decks for early pre-seed and seed round companies to draw the attention to raise the capital. So we got a little bit of foundation in terms of what we should expect and how we want to raise, and now we got to go figure out how to raise it. So deck building is critical. Story and narrative and vision are the number one items. So we'll send it out shortly, and we appreciate everyone being here, and have a great rest of the week.
Cheers. Thanks, y'all.